All right, let's pull back the curtain on how the pros really analyze stocks. We're going to demystify this whole process and turn what feels like some kind of financial wizardry into a clear, step-by-step playbook you can actually use. You know that feeling, right? You look at the market, and it's just chaos. Thousands of companies, a nonstop news cycle, and everyone shouting different advice. It's enough to make your head spin. But what if there was a way to just cut right through all of that noise? Well, that's the big secret. The best investors aren't just getting lucky or chasing hot tips. Nope, they use a system, a structured, disciplined process that filters out all the drama and hones in on what actually matters. And today, we are opening that exact playbook for you. So here's our game plan. We'll start by going from chaos to clarity. Then we'll dive into the 7-step analysis funnel, see it in action with real companies, and finish up by talking about how to build a portfolio and steer clear of common investor traps. Okay, section 1, from chaos to clarity. Let's get right into why having a methodical approach is probably the single most valuable tool you can have in your entire investment kit. At the very heart of it is this idea: systematic investing. I want you to think of it like a giant filter. You pour the messy, chaotic, emotional market right into the top, and because of a series of rule-based checks, what comes out the bottom is a clear, logical decision. The whole point is to replace fear and greed with a calm, repeatable process. So what does this process actually look like? Well, that brings us to section 2, the 7-step analysis funnel. This is the exact framework that can take you from thousands, and I mean thousands, of options down to just a handful of really great potential investments. And here are the steps. See, it all starts broad with screening just to find some interesting candidates. Then you gotta dive deep to really understand the business and its financials. From there, you figure out its valuation, what's it actually worth, and you identify the key risks. It's only after all that that you make a decision and figure out how it fits with everything else you own. So let's see this thing in action. Welcome to section 3, the process in action. Theory is great and all, but let's make this real. We're about to run 3 very well-known companies through our funnel and see exactly where the process takes us. First on the list, Asian Paints. Now, our screener would flag this almost immediately. I mean, just look at these numbers. It's a massive company. And check out that 5-year average return on equity, or ROE. It's over 23%. That's an incredible number. It tells you this company is just brutally efficient at making profits. Plus, it's got solid growth and, this is huge, basically no debt. This is what a high-quality business looks like on paper. But this is where the real analysis kicks in. On one hand, you have these incredible strengths. It's the dominant market leader, its distribution network is a fortress, and the balance sheet is rock solid. But on the other hand, you've got some very real risks, especially with things like raw material costs swinging all over the place. And here's the kicker. Because everybody knows it's a great company, it always trades at a premium price. So for now, our system leads to a clear conclusion: hold. This is a classic case of an absolutely exceptional business trading at a fair price. But here's the thing, fair isn't cheap. For a brand new investment, we're just not seeing that margin of safety, that all-important buffer you want against things going wrong. It's a great company to keep on the watch list for sure. Next up, HDFC Bank. Another giant, solid returns, but look at this. A net NPA ratio of just 0.3%. Now that's a measure of bad loans. And believe me, that number is insanely low. It basically screams best in class. But here's the real kicker, the potential opportunity. Its price-to-book ratio, a key metric for banks, is sitting at 2.8. Notice how that's meaningfully below its historical average of 3.2. So we dig a little deeper. The strengths are obvious. Top-tier asset quality, super efficient operations, and that key point we just saw, it's trading at a discount to its own history. The risks? Well, they're mostly bigger picture things. How interest rates move, new competition from fintech, and, the usual threat of regulatory changes. And that means the system's decision is crystal clear. Buy. This is one of those moments where you have an undisputed market leader with fantastic fundamentals that appears to be on sale relative to its own past. This right here is what it looks like when quality meets opportunity. And our final case study for today, the IT giant Infosys. The numbers that just pop off the page here are that mind-blowing return on equity, averaging over 28%. And look at this, 60% of its revenue is now coming from those high-growth digital services. Plus, it pays a pretty decent dividend while you wait. So the strengths are pretty obvious. Infosys is a powerhouse in the new digital world, and its client base is so diverse, it spreads out the risk. But the IT sector has its own unique set of external risks. Things like currency swings, changes in visa policies, and that big question mark hanging over everything. What will clients spend if the global economy gets shaky? And so our system ends up in a familiar place, similar to Asian paints actually. Hold. Infosys is without a doubt a world-class company. It's a quality compounder that's perfect for steady, long-term growth. But based on its current price, the system says it's pretty fairly valued. A fantastic business to own, but maybe not a screaming buy at this exact moment. And this brings us right to section 4, building your portfolio. Because look, making a buy call on a great stock like HDFC Bank is only half the battle. How that stock fits into the bigger picture, your overall portfolio, is just as crucial for managing risk. It's only one piece of the puzzle. See, a professional portfolio isn't just some random collection of stocks they like. It's a balanced team. This chart shows one way to think about it, by diversifying your investment style. You want a mix of everything. Some high-flyer growth stocks, some undervalued value stocks, some income-producing dividend stocks, and some stable defensive ones. That balance is what helps your portfolio do well no matter what the market is doing. And here's what that looks like in the real world. So let's say before we buy, our portfolio had 15% in banking stocks and 10% sitting in cash. The action is to allocate an 8% position to HDFC Bank. Now look at the after column. Our banking exposure goes up to 23%, which is still inside our imaginary 25% limit for any one sector, and our cash gets put to work. It's a deliberate, measured move. It's not impulsive. And that brings us to our final section, avoiding investor traps. Because I'm telling you, after all this hard work and analysis, the single biggest threat to your returns often isn't a market crash. It's your own mind. It's the predictable, emotional mistakes we are all wired to make. Here are 3 of the biggest culprits. First, confirmation bias. That's when you only look for news that agrees with what you already think. The fix? You have to actively go looking for arguments against your investment. Second, loss aversion. We all hate losing, so we hold on to losing stocks way too long just because it hurts to admit we were wrong. The fix for that is to predefine your exit rules before you even buy. And third, herding behavior, just buying a stock because everyone else is. The fix is simple. Trust your own research first. Your system is the shield that protects you from all of this. You know, this quote really just says it all. This isn't about finding some magic formula that works one time. It's about committing to a process, practicing it over and over, and always learning, always refining your skills for your entire life. So we've walked through the entire professional playbook, from filtering the whole market down to a single stock, to making a decision, and so importantly, learning how to avoid those mental traps. This whole process is designed to give you clarity and confidence. So really, there's only one question left. Now that you have the playbook, what's your first step going to be?